Hello and welcome to this market and economic update. In this video, we will cover what took place in financial markets during April 2026, what is behind the current conditions, and why it all matters for your investments. April turned out to be a standout month for investors. Even with ongoing tensions around the world and continued questions about energy prices, major stock market indices climbed to record levels. The S&P 500, an index that tracks 500 large U.S. companies, rose more than 10% in a single month, making it one of the strongest monthly gains in the index's history. That said, there are still real hurdles ahead, including questions about who will lead the Federal Reserve, the central bank that manages U.S. interest rates, and elevated oil prices. But April is a strong reminder of why it pays to stay invested and stick to a long-term financial plan. First, let's take a step back and look at the bigger picture around April's strong performance. Even after a tough start to the year, the S&P 500 is now up about 5% for 2026 as a whole. The NASDAQ, a market index that includes many technology companies, rose more than 15% in April alone. Stocks in emerging markets, meaning countries with developing economies, also gained nearly 15%. It was a broadly strong month across many parts of the market. As this chart shows, looking back at yearly S&P 500 returns going all the way to 1928, the market has finished the year in a positive territory in roughly 2 out of every 3 years. Since 1980, that figure is even higher, closer to 3 out of every 4 years. This tells us that while down periods are a normal part of investing, the overall direction over time has been upward. In fact, some of the biggest monthly gains in market history have happened during times of great uncertainty. After the 2020 pandemic, the 2022 downturn, and the tariff-related market drop in early 25, for example. This does not mean markets always bounce back quickly, but it does show how hard it is to predict the right time to buy or sell, and how much an investor can miss out on by waiting on the sidelines for the perfect moment to get back in. Next, let's look at the Federal Reserve, which held a key meeting in April and is also preparing for a change in leadership. The Fed chose to hold its benchmark interest rate, the main rate it uses to influence borrowing costs across the economy, steady, keeping it in a range of 3.5 to 3.75%. What stood out at this meeting, though, was the level of disagreement among committee members. 4 of the 12 voting members voted against the majority decision, the most dissenting votes since 1992, showing just how divided policymakers are at the moment. That division reflects 2 competing pressures: concerns about the job market on one side and concerns about rising inflation driven by high oil prices on the other. Because of this uncertainty, market expectations are now roughly split between the possibility of a rate cut and a rate hike later in 2026. This meeting was also the last one led by Jerome Powell as Fed chair, ending a term that began in 2018. Kevin Warsh has been nominated to take over and has already been approved by the Senate Banking Committee. A leadership change does bring some uncertainty, but it is worth noting that markets in the broader economy have navigated many different Fed chairs and interest rate environments successfully over the years. Finally, let's look at oil prices, which are the most direct way that the conflict in Iran is being felt by everyday investors and consumers. Brent crude, a widely used global benchmark for oil prices, ended April above $114 per barrel. Prices moved sharply throughout the month as talks about a ceasefire near the Strait of Hormuz, a critical shipping route for oil, repeatedly fell apart. The main concern for investors going forward is whether high energy costs start to ripple through the broader economy, pushing up transportation and production costs for businesses, which can then lead to higher prices for consumers. That said, it helps to keep some perspective. Historically, sharp rises in energy prices have often turned out to be temporary once the underlying situation settles down. For investors, the energy sector, meaning companies involved in producing and selling oil and gas, has been a strong performer this year. As markets recovered in April, other sectors like technology also contributed positively. This is a good reminder of why holding a diversified portfolio, one that is spread across different types of investments, continues to be an important strategy. We hope you found these insights helpful. If you would like to learn more about any of these topics, please don't hesitate to reach out. We look forward to speaking with you.